Hi, my name is Richard Veltri. I'm the CEO of Harbor Rock Consulting. We've been servicing small and mid-sized companies for the last 20 years. Today we're going to talk about how to register a new company. You want to start a new business, you have to actually form it and make it live so that it can run properly. And there's several ways to do this, depending on what kind of entity you are actually going to start. A lot of people have heard that you could be a sole proprietor, you could be a partnership, you could be an LLC, or you could be a corporation. And the first thing you have to do is decide which one. But in this video, we're just going to talk about how to go about registering it. I'm assuming that you have decided what kind of entity you've already done. First, if you're a sole proprietorship, most of the time a sole proprietor is registered on a local level. If it's just you going out and doing business under your own name, there really isn't much of a registration process that you need to follow. If you are using a fictitious name, meaning that you're naming your company something to show what service you're providing, then you would want to go ahead and register that business at your local level with the business name. That way you are recognized by your local area, and also you can use that name in the federal government to obtain an employer ID number and pay employees, etc. At the next level, if you are going to be an LLC, there are two types of LLCs, which would be single member or multi-member. And as simple as I can possibly say it, single member has one owner and a multi-member has more than one owner. You have to register an LLC, whether you're single member or multi-member, you should register it the same way. And it's done at the state level. You want to actually go to the state where you are operating and find out how to actually file the forms called a certificate of formation. That will tell the government what kind of business you're running. It will tell the government how you want to go about actually filing forms with them every year. And it will tell them a little bit about the ownership of the company. It will also register the business name so that you can legally be using it around when you're doing your work. A corporation is filed the same way. A corporation is filed with the state that you're going to be doing your work in. It could also be in multiple states, by the way. But for the main state is where you start. You start by filing a certificate of incorporation, same way we just talked about the certificate of formation. You go to your state level, get the proper form, and you fill it out, giving them the same kind of information. What your ownership structure is, who's going to be the owners, where you're going to operate your business out of. You need this information filed with the government, again, so you can work with the government and file the proper forms for payroll, for sales tax, for other things that you have to do. The corporation could also have a secondary effect. You could also be filing it to become an S corporation, which is similar to a partnership, but that's a video that we'll talk about in another time. So for now, just find forms for the proper type of entity that you want to register, and you can do that through the state. We're going to talk quickly about how to form an EIN and why you might want to do that. An employer ID number, also known as EIN, is the number that you get identified with the U.S. government through the IRS. This is a number that if you have employees, you need to have one of these in order to pay them their payroll and record the payroll taxes that you're supposed to be handling. It's very easy to get one. You can get one on the IRS website at www.irs.gov. And what you would do is spell out exactly why you need one, and they will issue one right there on the website. You would need to use this for a lot of things. When you get one, you'll notice that it has 9 digits, and the 9 digits is exactly the same as your regular Social Security number. The difference is you want to have one of these so you can separate yourself from the business. The business would have its own identity and its own responsibilities to the IRS. It takes some of the responsibility off of you, because the IRS would then be looking at the company to make sure you're in compliance with filing your payroll taxes and your other forms that you need to for the business. Today we're going to talk about what is an S Corp. S Corp meaning S Corporation. Basically an S Corp is a corporate entity that has decided to make a tax election. What people don't generally realize is that an S Corp is really a C Corp that's only made a tax election with the IRS. from a legal standpoint, a C corporation and S corporation are exactly the same. An S corporation makes an election to be treated as a partnership only for tax purposes. What that does is it says to the government, we are going to, as individual owners of an S corp, we are going to pick up our share of the income of the corporation on our personal income tax returns. And what that does is it eliminates the double taxation that happens in a C corporation. A C corporation pays its own tax and then turns around and either pays its owner's payroll or pays a dividend, both of which would be taxable to the individual, creating a double tax situation. On an S corp, you make this election, and the S corp itself does not pay income taxes. What it does is it sends out a form to each individual owner saying you have to pick up your percentage ownership of our profit for the year. And then as individual owners, you pick it up on your personal Form 1040 when you file that at the end of the year. And S corporation files a Form 2553 to make the election. There are specific time frames for actually filing that 2553. And it is only valid with certain types of shareholders. So there are other things to think about in order to make an S corporation election, but that could be handled in a different way. You could give us a call at 888-293-3883 if you have additional questions about that. But for now, that is what an S corporation is. Thank you very much for watching. Today we're going to talk about what is a C corporation. I have spent a lot of time in my career working on C corporations, mostly because C corporations may be the only entity in the U.S. that's available to a foreign company doing business in the United States. A C corporation is formed with the Secretary of State of the state that you're going to operate in. It is a state-level setup, and you file a certificate of incorporation in order to operate as a corporation. It creates a new legal entity with the jurisdiction of the state where you filed. A C corporation is not usually an entity that we recommend to a startup or a small business because there is an issue of double taxation. The double taxation comes in because as the C corp makes a profit, it pays its own income taxes to the U.S. government, and then when it actually pays out payroll or dividends to the owners so that they can take their profit, those owners then pay tax on the dividends or on the payroll that they receive. So that creates a double tax situation which can be easily rectified using a different kind of entity like an LLC or an S corp. So we don't necessarily recommend a C corp structure for a startup or a mid-sized business. Just about every company, I think probably every company that's registered on the stock exchanges are C corps because they are specifically set up to operate that way. So a C corp is generally an entity for a larger entity, for a larger business, for a larger enterprise, and so we don't necessarily recommend that to startups and small businesses. Today we're going to talk about what is an LLC. We've heard a lot of conversation about using LLCs in business, and over the last 20 years it's become a very prevalent entity for setting up a new business. There are a few reasons for that. It's what we know, what we usually call a hybrid entity, in that when you register an LLC, you are filing for limited liability protection from a legal standpoint. What you are not doing, though, is you are not forming a full-blown corporation. You are filing an entity that, for limited liability purposes, is treated like a corporation, but for tax purposes is treated like a partnership. So for C corporation purposes, this means that you still have the same legal liability protections that you would expect when you set up an entity like this. You want to use this entity because you want to protect your personal assets. So you set it up with the legal standing that you want to be separate from your business. For tax perspective, though, The percentage of ownership that you have in the LLC dictates how much profit you actually pick up personally. So if you and a partner are 50-50% owners of the LLC, you would pick up 50% of the income, and your partner would pick up 50% of the income on your personal income tax returns. So what would happen is the LLC pays no taxes, and then the percentage of profit would be dictated out to you so that you can record it on your personal returns. The LLC has become one of my favorite entities because it gives you a lot of flexibility with how you can structure sending out the profits, who picks up the profits, who picks up a little bit more of the income because they do more of the work. There's a lot of flexibility in how you can structure it. Today we're going to talk about double taxation, something that's very common, very commonly misunderstood or not even understood by small businesses who go and register and someone convinces them to set themselves up as a C corporation. A Chapter C corporation is one that has not made any kind of specific tax election. They have just filed a certificate of incorporation, and at that point they are classified as a C. And what that means is they are going to pay tax to the U.S. government and their state governments on the basis of the profits of the corporation. When the corporate profits are paid out as dividends or payroll to the owners, then those owners have to pick up that income on their personal income tax return, and therefore you have double taxation, one time paid by the corporation and another time paid by the individual who owns the corporation. The ways to avoid double taxation would be that you use a different entity. C corporation is not necessarily the ideal entity for a small business. There are ways to use C corporations, but the thing that people forget is that if you're in a growth mode and you're trying to grow a business, which a lot of startups and tech startups are trying to bring in money and grow, the problem is what happens when you're a C corporation and you eventually sell the assets of your company. If you sell the assets, it's capital gain, which is going to be taxed at the C corp level. And then when you take the money out, you're going to get taxed again. So I never feel like I should be talking C corp to a newly formed business, and we should be talking about other entity options which would avoid the double taxation issue. For the first option would be if you're the only owner, then you would set up a single member LLC, which would be treated like a sole proprietorship, and at that point everything would be recorded on your personal tax return. No issues with a corporate structure. The second option would be a multi-member LLC if you have more than one owner in the company, and that would mean that you're treated like a partnership. And partnerships do not pay income taxes to the U.S. government. The money flows out to the owners in their percentage of ownership, and they pick it up on their personal return. The other option would be to take the C corp that you just formed and file a Form 2553, which is a small business S corporation election. What that would mean is that for tax purposes, and only for tax purposes, you would be treated as a partnership. S corp rules are slightly different than partnerships, but as far as tax flow through goes, the partnership, the S corp's income gets flowed out to the individuals in their percentage of ownership, so that the individuals pay tax on it, but then the S corporation pays no corporate income tax. Again, those are three options right there that would avoid the double taxation issue. Today we're going to speak about doing business as yourself, and then whether or not that's a good idea. People starting a business generally just go out and they start finding a way to make some money. It could be a landscaping business, it could be a startup technology company in your basement where you've done some programming and you came up with a really good idea. So you try to sell it and you start selling product or you start selling service, and you instantly have a business. The problem is most people don't realize that when you do that, you are exposing yourself to personal liability on your personal assets. In other words, if you do something wrong, if you're a landscaper and you do something where someone gets hurt on someone's property, or if you do something where you sell a product that doesn't work and you wind up in a legal issue with the person who bought it from you, they're going to sue you personally. And the minute that they sue you personally, your personal assets are on the block. What that means is if you have a big bank account, if you have a house, if you have cars, whatever your assets may actually be, they're exposed because you don't have anything protecting them. There's a couple things you can do to rectify that situation. First is you would want to make sure you have a business liability insurance policy, something that would easily protect you from any kind of lawsuit, from an error in omission of something that you did. So you would want to have that policy. The second step would be to try to figure out if you can register your business as another kind of entity. Don't do business as yourself. Do business as an LLC or an S Corp or a C Corp. There's a lot of decisions between which ones to make, to which ones to actually decide to use. But I would definitely recommend that you select one of those types of businesses and set up your enterprise within that legal framework. Reason being, again, you don't want to get sued to the point where your assets are exposed. You don't want to lose your house because somebody down the street didn't like the product or the service that you provided and then took you to court over it. So I always recommend that people think about setting up an LLC or an S Corp or even a C Corp if that's what they really want to do. But that would be my recommendation. Today we're going to talk about the need for a commercial bank account. A lot of people who just start up a business and run it under their own name will be able to get paid from their customers or clients and just cash the checks in your personal bank account, and that's just fine. There's no reason to worry about that. But a lot of people will go out and they'll actually start an LLC or an S Corp or even a C Corp. And the problem is they don't realize that you do need to go and get a commercial bank account. And the reason that you need to do that is you can't cash a check made out to a business name in your personal account. It has to go legally to a business bank account. So it's very easy to set up, but you do need all of your formation documents. You need your employer ID number, and you need to make sure that everything's properly registered so that when you take that paperwork to the bank, they have no issues with trying to verify that the business is set up and ready to go, and then they can set you up with a commercial bank account. You can definitely set it up in different ways. That's up to your bank that you want to bank with, and you definitely should pay attention to what fees they're charging you for your commercial bank account. Make sure you're not signed up for some enterprise level bank account when you're a newly formed startup, because the bank account fees would actually take too much away from you actually being able to run your business.